Hello everyone, it's Davide here. Welcome back to Learning Finance. In today's video, guys, I'm going to bring you a fundamental analysis and valuation of Exxon Mobil Corporation, ticker symbol XOM. One of the biggest companies, oil companies in the US, okay? And it's actually paying a very nice dividend, around 8%, okay? So probably many of you are thinking, well, could be a great investment, okay? 8% is not bad. So this is what this analysis is for, to see if the stock is worth it or not. So leave me a like if you find this video interesting. You're gonna help me with the channel, and subscribe to the channel so you won't miss out any new stock analysis like this one, okay? So let's begin. Alright guys, so first thing is to understand the business of ExxonMobil, okay? So segments by revenues in 2019, if we go to the 10K official annual document that every company is released, we realize that ExxonMobil, in terms of revenues, okay, not net income, but revenues, it's making the 9% of it through upstream business. What is the upstream business? It's everything related with oil extractions, okay? So the drilling business, wells and stuff like that. Now, ExxonMobil has a very diversified portfolios of locations, okay? All around the world, they have wells and they drill oil, okay? They extract oil. And this is very positive because with a very diversified portfolio, you avoid single country risks. Okay, so probably like if a country releases a new policy which is against oil drilling, well, you don't get hit a lot. Okay, and this is very positive. Now, the downstream business, 80%, what it is? Refineries. Okay, so once you have the oil, you have to treat it, you have to work it, and you have to transform it in other products. Okay, like for example, jet fuels, oil for engines, and stuff like that. So from the crude oil, which is the raw material, you do all the stuff. And this is refineries, and it's 80% of their revenues. Now, in this business, you make money basically by taking the price of the transformed product minus the cost of a raw material, okay, so the crude oil. And we have chemicals segment, okay, which is 11%, and basically this is very related to refineries, because with oil we make plastics and stuff like that, also t-shirts, okay, so a lot of things you make with crude oil. And if you go to check the annual document, they say that basically they have an advantage, okay, with that, a competitive advantage because of the refinery business, okay, so for them it costs less to actually do chemicals, okay. Now, when we check for net income instead of revenues, we realize that the situation is opposite. So basically, more than 80% is made by the upstream, okay? We can see clearly from here. 2019 upstream in the US, 536 million. In outside US, because I told you that they have a very diversified portfolio of locations, they made around 13.9 billions, okay? Comparing with the downstream, that makes a total of 2.3 billion, and chemicals, which is below 1 billion, okay? So not very much when it comes to net income. Now, what does it mean? It means that the earnings of ExxonMobil are very, very correlated to the oil price, okay? So this is now, of course, in 2019, they got hit, okay? Now, to make you understand the correlation better, I realized this graph. Basically, here you have the crude oil price on the top, earnings per share right here, and ExxonMobil stock price, okay? So what is very, very interesting to see is the correlation between those things. Are all from 2006 to until today, okay? So when the oil price spiked up before 2008, and after that we had the crash, we can see that also earnings per shares were going up, and after that down, and as well the stock price, okay? It's like 3 bounces, 1, 2, 3, and the minimums here for the crude oil back in March, and here the same stock price, 1, 2, 3, and the minimums. Okay, so the lows back in March again, and look at that, look at the earnings per share as well, 1, 2, 3. This is what it is. The correlation is very, very high. So what we have to understand is also how much it should be the price of crude oil during the next years, okay, because this impact very much with the stock price. What we have to keep in mind is that during the last 7 years, basically, we didn't have the crude oil above $100 per barrel, okay? And in my opinion, this is gonna be the new standard because crude oil is not gonna be used as much as it was used before because of new technologies, electricity, electric stuff, hybrid, and all those kind of companies like Tesla, all those things is gonna be the future, okay? So, but you know what? It's not gonna die tomorrow because not just cars are going with crude oil. And remember that those companies, they have also chemical stuff and they do actually products which are very useful. We don't even realize how much crude oil is useful. Anyway, in my opinion, in the next year, we are not gonna see a crude oil above $75–80 per barrel, okay? So basically what it could happen, in my opinion, is to have the crude oil from 40 today to go back around 60, 65, 70s, and the stock price, okay, would bounce as well. We have to see how much they're going to be able to increase margins and stuff, but overall I see the stock back around $65–70 per share, okay? And the earnings as well, it's all correlated, so we could have another bounce, okay? Another bounce out of the screen here. And this is basically the bet you're making when you invest in those kind of oil companies, okay? You are investing in the idea that the oil, okay, is not as used as before, but it can bounce back, okay? It can bounce back because we had a pandemic, which has been probably something that no one was expecting. And basically those lows that we made in the crude oil prices is something exceptional, okay? So one can think, well, okay, it's not gonna be the future, the crude oil, but it can be a nice investment for a bounce back, okay? I don't mean we are gonna see the crude oil at $140 per barrel like here, but why not, okay? 70, and all those things would go up correlated to it. So now, what is the important thing and the interesting thing about Exxon Mobil? Well, the dividends. Now, it is a dividend aristocrat together with Chevron Corporation. They are the only two oil companies that are actually dividend aristocrats. ExxonMobil is increasing consistently the dividends since 37 years in a row, okay, which is a lot. And we can see this is the payout dividend, okay, back in 2000, the last 20 years, and it's always going up consistently. And right now we are around $3.48 per share every year, okay? And we can see the dividend yield that basically has always been around 3-4, okay? And as well, because this is correlated with the stock price, okay? So the stock price lately went down drastically, so of course it's math, okay? The yield has to go up. Now, the main question was, will ExxonMobil be able actually to pay this high dividend in this very bad moment? And the answer, in my opinion, is yes, because after 37 years, you have a reputation, okay? You are a dividend aristocrat and you don't want to lose that reputation. I think they will make whatever it takes to pay the dividend this year and to increase it. Now, what is the main problem with this? The main problem is that right now, I told you that the dividend is around 3.48 per share. But when we look at earnings per share, they are lower, okay? So what that means, when we go back here, we realize that the payout ratio has been above 100% in 2016 and 2019. What that means is that they were paying more in dividend than actually the net income that they were making, okay? Usually it's around 60% payout ratio, but due to the volatility of the oil price, well, sometimes that happens and will happen again, of course, in 2020, okay? If they want to keep the dividend, the payout ratio will be huge because the dividend per share is going to be 3.48, but the earnings per share, guys, are going to be probably negative, okay? Minus 0.20. Anyway, I think that they are gonna maintain their promises in 2020, okay? And we have to see what will happen later on, because ExxonMobil together with Chevron Corporation, they have the lowest debt in the oil industry, okay? We are gonna see right now in the balance sheet, look at that, total assets divided by total liabilities, they have a lot, 2.13 as a ratio. Now the current ratio, of course, is not much. It's 0.78, is below 1, and this is typical of all the very tough industries like oils, like airlines and stuff, because especially for oil, they need to use debt, they need to make long-term investments which are huge in amount of money needed, okay? And to see results, you need to wait, you have to wait. It's very difficult to actually have high current ratios when it comes to the oil industry. But this one, well, this one is very positive. This one is telling you that, okay, even if 2020 is not good, we have a lot of assets and we can do a divestment, so sell something to take some cash and maintain our promises. Look at that, debt to equity ratio 31.58%. When it comes to the net debt, so we deduct the cash, and we have 25.54. That for a huge company like ExxonMobil is very positive. Now consider that I showed you a couple of days ago, Coca-Cola, they have more than 150%, okay, and Pepsi even more. So for an oil company, I told you that, in my opinion, this one is not too bad. The market cap is around $189.33 billion, and the book to value, guys, it's 1, okay? It's basically the same. This one and this one is 1 point something. This is telling you that in terms of the book to value valuation, so the balance sheet valuation, ExxonMobil is trading at a fair price today, okay? We're going to do a valuation with discounted free cash flows to see what we have. So here, as always, we have our discounted free cash flows model. We have the free cash flows, and I'm going to go quick into it. And as always, we have net incomes over the last 5 years. We have revenues and capital expenditures, and we are going to try to forecast the next 4 years, okay? Now, analysts are saying that 2020 is going to be bad, minus 30% in revenues, and a loss that for the first time in a lot of years in a row, ExxonMobil is making a loss. Believe me, this is a company that makes money consistently every year, okay? So this is something exceptional for them. And that's why I'm not too worried about it, because it's not something that happens every year, okay? This is a black swan event, and it's quite normal to have a loss, okay, for a lot of companies out there. Anyway, in 2021, they are saying that they are gonna bounce back, and I did 2 scenarios, a 13% scenario, a 14% scenario, and after that I took the analysts' estimates, okay, which are even more positive than mine. The requirements of this valuation are a WACC of 7.5%, a perpetual growth of 2.80%, which is basically very low for a company like that. Is basically the same of the United States economy, okay, as perpetual growth. What we have with the 13% scenario is that the today's company valuation with this free cash flows is $215.50 billion divided by the total amount of shares outstanding. We get a fair price of $50.95. Now, ExxonMobil has $48.2 billion in net debt, which we have to deduct from the today's company valuation. That gives us an adjusted company valuation of $167.3 billion divided by the total amount of shares outstanding. We had the adjusted fair price of $39.55. Okay, with the 14% scenario, again, the requirements are still the same: 7.5 as a VAC, 2.80 as perpetual growth. We have that today's company valuation $220.8 billion, and when we deduct the net debt, we have an adjusted company valuation of $172.68 billion divided by the total amount of shares outstanding. We get an adjusted fair price of $40.82. Okay, so these are my estimates. Now I'm gonna see the analyst estimates. Same requirements. They say that 2020 is not gonna be too bad because they are predicting a bounce back in the last 2 quarters. Okay, now the first quarter for Exxon has not been negative. Okay, has been positive actually. So they are saying that Q2 is gonna be bad, but Q3 and Q4 they are not gonna be so bad, and Exxon is gonna avoid a loss. That's what they are saying. So those are the other estimated free cash flows. We have a today's company valuation of around $279 billion. And when we deduct for the net debt, we have an adjusted company valuation of $230.90 billion divided by the total amount of shares outstanding. We get a fair price of $54.59 per share. Okay, I took the average and I get a today price for ExxonMobil fair price of $44.99 per share. Okay, so this is basically $45. And when we go to check, we realize that ExxonMobil is trading today at $44.23 per share. Okay, so basically it's exactly at the fair price. Okay, now with this kind of price, we actually have a dividend which is estimated around 7.82%. Okay, because you just take this one and you divide it by the today's share price, okay, which we said is $44.23. So this is what you have. Now, this is actually very, very interesting if you believe in the fact that we are gonna go out from this pandemic and the oil is not gonna be the future forever, but it's not gonna die tomorrow, okay? And those huge companies, they can also transform some of their operations from purely on oil or on more of the chemicals stuff. Okay, so the company actually is not gonna die, but it's gonna transform some of their operations. Now, honestly, I believe in a bounce back because remember that those prices that we see right now are because of the pandemic. Okay, we don't have hopefully a pandemic every year. This is a black swan event. So if you are wondering what is my position, guys, is that I bought ExxonMobil back in March. Okay, but I didn't have a channel at that point. Anyway, I bought the stock back in March with this very analysis that I'm showing you right now. And so I bought at $34.76 per share. And when I divide it and I consider the dividend that I take is 10%, okay? Because you just take 3.48 and you divide it by the price I bought the stock, okay? So I fixed a dividend yield of 10%. And I was pretty confident about the fact that they would maintain the dividend. And that's what they did, actually. In the heart of the problem, in the heart of the pandemic, they paid me a dividend, okay, as they promised. So is still a buy today? Well, in my opinion, if you like dividend stocks, 7.82 as a dividend is a very interesting yield. If you believe that they are gonna keep it, like I do, well, it can be something to think about. Okay, there are not many stocks out there that they pay this much of a dividend and they are reliable. Okay, in my opinion, ExxonMobil can be reliable in the next at least 5 years, which is my timeline for this investment. Remember, the debt to equity ratio and the net debt is very low, so even if things are not gonna be bad and not gonna be good in the next couple of years, even if this bounce back is going to take some time, they will be able to sell some assets to create some cash to maintain their fame as dividend aristocrats. Okay. Now, of course, it is not a healthy payout ratio. So this is something that you have to keep in mind. Now, the thing is, it's going to be bad for the next couple of years. Hopefully, it's going to come back to those levels, okay? Around 60% of payout ratio, a healthy payout ratio for an oil industry. So overall, I hope you find this video interesting, guys. Leave me a like and tell me if you own ExxonMobil or if you're planning to buy some. I did this video now because, as I told you before, I didn't have a channel back then, so I couldn't show you that. But I'm bringing you this video to the channel because basically the stock went up and hit around $55, but now we are having a pullback. And why not? If it goes down a little bit more, you have this video so you can try to evaluate whether it's a nice buy for you. Okay, you have the fair price, you have the valuation, just it's your call. Okay, so leave me a like and have a wonderful day, guys. See you in another video.